Thank you for joining us here today at Stop My Crisis with Vivian Gaspar. I'm your host, Vivian Gaspar, and today I have with me Harry Herbst of Harry Herbst & Associates, a life, health, and disability insurance broker here in New Jersey for the last, 38 years now, Harry? And wonderfully to say, he's also a Vietnam vet, which of course we're very grateful and proud of your service.
Thank you.
Thank you for joining me today and to educate my viewers here on what is going on now and in the future with the Affordable Care Act. Harry, please tell me, with the elections coming up for a new president in a mere matter of 5, maybe 6 months, tell me, how do you see the future of the Affordable Care Act depending upon who our next president will be? Democrat, Republican, what is the outlook?
Well, hopefully the outlook has to be positive. The campaign, the platform that our Republican candidate is running is that currently it's not working and people are in trouble. And I would, as an agent, I would certainly agree with that. I would agree that it's we're having difficult times. So he's essentially stating that he's going to revamp. Exactly what that means, I don't know, but I do know what we currently have is not working well.
So let me ask you, what do you mean not working? How you primarily work a lot of times with small business owners. What is it you're hearing from your clients that you have come to the conclusion, and a lot of people have, that the Affordable Care Act that took well over $300 million to implement is not working? What do you mean by that?
What I'm hearing from the business owner is, help, we're being devoured. I paid $3,000 a month last year. Now the insurance carrier wants $4,500 a month. Boy, that's a 30% increase. I can't. That's unconscionable. And so that's what I mean. The small business owner is really having a very, very hard time. There's a lot of aspects in the Affordable Care Act that I think need to be looked at again. I indicated essentially for older Americans over 55 that the way it was calculated is really, really adverse to them and puts them at a disadvantage. And I understand the rationale is that, quote, older people cost the insurance carrier more money. So these are a couple of examples of situations that are not working as well as they should be.
I need to ask, what exactly does age rating in insurance for health insurance mean? How does that help people or hurt people? A lot of people don't understand what it was prior and what it is currently, especially in the aspect of age rating.
Great question.
How does that change things?
How it changed is essentially we used to use what's called a median rate. So if you have someone that's 55 and someone that's 50 and someone that's 30 and someone that's 25, you have a median rate, let's say, of age 40. Today, you don't have that. The 30-year-old is rated as a 30-year-old, the 40 as a 40-year-old, and the 60-year-old as a 60-year-old. So everyone's paying their own rating. And what I stated previously is that someone that's older is paying considerably more. And if you take a look at the rates, for example, a proverbial 60-year-old today is probably paying $900 to $1,200 a month for health insurance.
But wouldn't the 30-year-olds say, well, that's only fair? Why should they be penalized for someone who's older if you want to look at the shoe on the other side of the other side of the coin?
The 30-year-old is probably saying that, but the 30-year-old is saying, wow, I'm paying too much also. So everything is relative. If the 30-year-old is paying $500 or $600 a month, they're not happy with that either.
Now, I understand that about 45% of the workforce is employed by the small business owner. Isn't that who your clientele is, the small business owner? And about how many employees do you see that the average client of yours has, the small business owners that you work with?
I work with small business owners commonly called mom and pops. Generally speaking, they have less than 10 employees. In many cases, they have less than 5 employees. And it becomes very, very important for them to, so if someone has 3 or 4 employees, the employee wants to make sure that they have health insurance. They may have a family, they may have 3 or 4 children or more, and it's very important for them to make sure that they're covered.
Now, let me ask you, under the Affordable Care Act, is it more expensive or is it less expensive for the typical family of 4 or 5. I mean, before it used to be, the head of household, spouse, and children,
that's
regardless
correct.
if it's 1 child or 5 children. But now, isn't it done per child, costing the household even that much more money than previously, before the Affordable Care Act was enacted?
We now rate it's considerably higher, to respond directly to your question.
But how's that the Affordable Care Act? I'm trying to understand this. Explain this to me and everyone else.
I just want to go back to a question you just mentioned a moment ago. It used to be for children. Now you pay for up to 3 children. So if you have 4 children, you're going to pay for the first 3. And that's going to really, really put a burden on it. So yes, the Affordable Care Act. The Affordable Care Act was at the simplest level designed to make sure that someone was uninsured is now insured.
How does that happen though? Because how do you ensure or make sure that happens? Because if most people are employed by a small business owner, at least half the population on average, and they're making it more difficult for the small business owners to afford health insurance, isn't there another downside to it that you have told me about?
There are several downsides.
List them for me. What are the downsides?
Well, first of all, back to the small business owner. If you go prior to the Affordable Care Act, their rates have probably tripled.
Tripled?
At least.
How is that affordable?
That's what most of these small business owners will tell you.
And is that what the Republicans are saying versus the Democrats? How is this working politically right now?
Well, that's what the Republicans are absolutely stating, and they're saying that was very, very forceful. And because that's what they're saying, it's the system is broken, and that's why I keep saying it's not working, and it's not working well. That's our Republican candidate. Without getting too political, our Democratic candidate is essentially somewhat happy with this, and in my opinion, will probably have more of the same.
Do you think that they'll just the Democratic candidate will just keep it the same status quo?
I think.
But what about all the people who are unhappy with it, finding it to be the Unaffordable Care Act, if you will?
I'm not sure what her position will be. Her platform at this point has stated that she's essentially going to keep it essentially the same. There may be some minor changes, but she hasn't verbalized what those tweaks may be.
Because of course, one would hope a relatively new program would make adjustments to account for the big complaints. So what would you find is the majority complaint that everyone has across the board? Or what's the most common one that you've heard?
The most common,
besides the expense.
affordability is big. Compliance is very, very big. What do I mean by compliance? We now have forms that weren't there before. A business owner has to have a payroll, has to have in New Jersey a WR30. The business owner has to show the ownership, which is a K1. So they've made it much more cumbersome. So what I hear from a business owner is, why are you asking me for all these documents? I've had this plan for 10 years. No one has ever asked me for these documentation
Does that cost
before.
them more money to have all these additional forms completed?
Sure. Ask his payroll company, ask his CPA. Yes, the answer is yes.
So then my question is, do you see from all the clients you've had for many years that it actually hinders them to hire more people? Or is that the way it is? Is it easier for them to hire more people and put them on payroll and, of course, health insurance? Or do you see them keeping to part-timers to make it so they don't have to have those employees full-time to provide them with health insurance? What do you see?
I see a lot more, and I want to give you one example, but I see a lot more of employees being part-time.
That hurts people. The average American who's W-2, not business owners, are trying to find gainful employment. Doesn't that hurt them?
So they tell the employee, just for example, you can work Monday to Thursday. You don't have to work on Friday. That makes them a part-time employee depending on the hours. So now they don't have to offer health insurance. And I can give you a couple of real life examples where it's really, really hurt. In one particular example, the individual said, but I've been with you for 17 years.
And now they just changed them to part-time all of a sudden?
It comes down to affordability. And so, yes, in that particular situation, the employer stated, when the situation gets better and the cash flow improves, I'll make you full-time again. But in the interim, now the person has to pay for their own health insurance. The person has to have health insurance because they have pre-existing conditions.
So my question to you will be, have you seen the Affordable Care Act where someone's a client, they're using it, they've mentioned it to you, Perhaps they were a sole practitioner instead of having many employees. But after 5 or 6 months, all of a sudden they're coming to you explaining, wait. Why has my premium tripled? Has it happened? Maybe they've had it since January or last November, and all of a sudden between, say, May and June, they call you up and say, wait a second, my offset's changed. The government's not helping me as much as they did last month, and I have no idea why. Have you heard this?
I hear this all the
And
time.
the premium out of their pocket has now increased threefold. What happened?
Or more.
Why is this happening?
Generally speaking,
So many questions.
generally speaking, insurance premiums increase once a year. In many cases, it's anniversary, which calendar year, or it could be a fiscal year, July 1st, or depending on the anniversary, generally speaking, it only increases once a year. However, in reality, in many cases, it increases much more than that. So if someone has an age change, for example, and moves what I call a box over, so they were 49 and now they're 50.
Brackets.
Bracket where you live. And in New Jersey, for example, we have 6 zones. So if someone lives in southern New Jersey, the rates in Salem County, Gloucester County may be less than they are in Bergen or Passaic County.
Wait a second. I had no idea. Are you telling me the health insurance expense that a person has changes according to where they live?
Yes.
And let's say it's out of New Jersey, hypothetically. Does it make a difference? I mean, if they're in New York, upstate, or
Yes, it
in
does.
New Jersey,
Yes,
someplace,
it does.
that
For
the
exam-
geographic location of where they live dictates their coverage?
Well, it dictates the cost, certainly. Residing in this great state of New Jersey, I need not tell you that living in New Jersey is
An expensive proposition.
an expensive proposition.
I think everyone agrees with that.
If you cross the river to Pennsylvania, for example, rates statewide in Pennsylvania by percentage-wise are at least about 15% less expensive
Wow.
in PA as they are. Now, at the other side of New York, if you take New York, the metro New York area, which consists of the 5 boroughs, Westchester, Rockland, that's quite expensive as well. If you go to some of the more upstate counties, again, the demographics do change. So if you take the 21 counties in New Jersey, some of the counties, that it's not treated equally. So
where we are right now, we're sitting here in Princeton, in the area, and you operate, your home base is out of Middlesex County, correct?
correct.
So in Middlesex County, and this area, Mercer County, and this vicinity, how do we fare here, right here, versus other parts of New Jersey for costs for health insurance?
Relatively high. Relatively high. Mercer County, for the most part, the Princeton area is high. For the most part, Middlesex and Monmouth counties are quite high. Most of your northern counties are quite high. Warren and Sussex may be a little less, but as you get more rural into your southern counties, you can see a price disparity.
Now let me ask you this. Is someone getting more of a benefit from working with you as a broker of over 35 years experience? Because obviously I have people coming to me all the time and what I do and say, hey, do you know somebody who's great and does this? Why does someone need a broker to rescue them from an emergency? How does that help? I've always wanted to give a good answer when someone asks me to refer them to someone.
That's a great question, Vivian.
I'm sure you get asked that all the time.
As a broker, it's important to work with a broker. I hear it all the time. Why should I work with a broker? You guys are fat cats. Well, first of all, we advocate. When the last time you called directly, you called Blue Cross or some of the other large carriers, and you were put on hold for about 23 minutes in frustration? You either hung up on or you hung up yourself. And our role is basically to advocate on their behalf. If a claim doesn't get paid, that's where we come in. So so
you can get claims overturned if someone's denied coverage for a reason. You can get that overturned.
We will put an appeal.
Does that help?
Yes, it helps.
Really?
I can't tell you that every claim gets paid, but we have a fairly good. We put in appeals. There's different levels of appeals, and many times mistakes are made. It wasn't coded. So everything in a doctor's office, everything is coded. Sometimes it's coded incorrectly. So you may go in, and forgive the humor, you may go in for a particular procedure, and they code it as a different procedure. So the cartoon definition person had a operation on the right leg, but unfortunately they did it on the left leg. So
hopefully that's not real life.
all of which has happened. But back to The question at hand, yes, it's a broker really advocates, and we play an important role to the consumer, and carriers have finally recognized that and see our role as being extremely important.
So my next question I have to ask, this is about the costs, and of course, is it really the Affordable Care Act or the Unaffordable Care Act? Especially how it comes to the upcoming whoever is going to be president. So my next question is going to be, what do you see the future being as we wrap up our time together between who's coming up next? The likelihood is, what happens if the next president decides to overturn the Affordable Care Act? What do you foresee will be the next outcome for health insurance for us all?
Well, hopefully it will be more affordable. The platform that our Republican candidate is running on is basically stating that he is going to overhaul the Affordable Care Act because it isn't working. What do I see for the future? I really can't see, hopefully, costs escalating much higher than they are right now. So I really hope that they will revamp the system, and make it much more affordable for the small business owner.
So you see the future, if we end up having a Republican president next, do you see the revamping taking place within what period of time? 1 year, 3 years? How long do you think that will take place?
I wish I
Will
really
it be
could.
the next term if they have another term, or will that take that long?
That's a very good question. I wish I had a crystal ball, but in my opinion, it will probably take the better part of about 2 years.
2 years to see any significant changes?
In my opinion, yes.
Until then, we have pretty much the same as we've had with the Affordable Care Act.
Pretty much.
Now, I've got to ask this one. As a broker, can you help save money?
Yes, I can.
That's all I want to know. You're going to help anyone who reaches out to you save money, because the biggest complaint that comes out of a small business owner's mouth is salaries and health insurance.
That's correct. We're the second
And we
line.
don't like to not have health insurance.
Try to be hospitalized for a few days and not have health insurance.
Share with me one 30-second tragedy that you can help overturn.
What we can take a look at is essentially taking a look at someone's policy, making it more affordable, perhaps adding a deductible, adding a co-payment, taking a look usually in networks and out-of-network benefits. So there is Tier 1 and Tier 2 with the Omnia plan. There's a lot of different things that we can look at to try to make things more affordable.
Thank you, Harry, for coming back and discussing this with us once again.
Hazardous chemicals. Could you be exposed at work? Employers are required by law to train you on the hazards of chemicals you work with, how they could harm you, and how exposure can be prevented. For information, go to njwec.org or osha.gov. This message brought to you by the New Jersey Work Environment Council.
Hi, welcome back to Stop My Crisis with Vivian Gaspar. I'm your host, Vivian Gaspar, and here with me today is Brian Cody, certified financial planner in New Jersey, as well as a retirement planning specialist. He is a former U.S. nuclear engineer and therefore the smartest and highest IQ financial planner anyone can ever have. Welcome here today, Brian, and thank you for joining me to educate my viewers on what I deem to be one of the most common mistakes I've seen as a specialist helping people with foreclosure hardship since 2008. Right. People make a horrible mistake taking their retirement assets out to save themselves inappropriately. So I'd love for you to explain to my audience, how do you do that appropriately? So let's say someone is in arrears with their mortgage. And they think to themselves, I don't know where else to get money from. Let me take a look at my retirement account. What would you say to that person?
Right. Usually when somebody comes into my office and they have that type of a question, the question might be reworded a little bit, where it's just like, do me a favor, tell me, should I do it or should I not do it? And my answer to them is,
do what though, Ryan? What is it they're looking to accomplish?
What is it they're looking to accomplish? Should I take money out of my retirement account in order to have that money pay off my debt that I owe? It's in arrears on my mortgage and I'm afraid of getting kicked out of my house. So if they ask me that question, then I say to them, well, truthfully, I can't give you the answer alone, just yes or no. What I have to do is I have to tell you the pros and the cons on both sides of it. And the pros of paying a mortgage off to keep it fresh is that you're making a nice home for your family. And a lot of these people will have children. They want to have stability, because when you're a young adolescent, there's many things going on in your life, and one thing you don't want to do is to have the challenge of having to move from one house to another and that stigmatism that might go along with it. So that's the first pro of actually paying off the mortgage. But then the cons come in, and there's a lot of cons associated with paying off the mortgage with a retirement plan asset.
Let me please clarify something with you. When you say pay off the mortgage, you mean to rescue someone from foreclosure, not pay off the entire balance to be mortgage free, correct?
You're right. I'm sorry. Yes.
No, I just want to make sure we're clarifying that for everyone.
Right.
I would like to make sure we mean rescuing a foreclosure, not just to pay off and be completely mortgage free.
That's right. We're talking about rescuing the mortgage, paying off that arrears amount of debt, and making sure that the loan is current. The challenge with that is that you're creating a tax consequence that is going to affect you for your tax return for that year. And if you're under 59 and a half, and this is a qualified 401k plan, a traditional plan, or a traditional IRA plan, you're going to find out that there's also, since you're under 59 and a half, a 10% penalty attached to the withdrawal.
10% can be quite substantial.
When you're adding it to the taxes you're paying, it can be onerous. So if you don't
What
mind...
kind of a dollar amount are we talking about? Because a lot of people I encounter who have the mortgage foreclosures that I deal with, their average for retirement account is about $100,000. And I have seen mortgage companies tell people to go ahead and liquidate their retirement accounts to get their mortgage current so they can keep their home. But what does it look like in an average $100,000 situation of a retirement account that's, let's say someone's only 45 or 50 and they're liquidating? And that's a pretty round number to work with. What would that translate to?
So if the person was told, liquidate your full $100,000 retirement account, approximately. I'm not a tax professional. They'd have to talk with their tax professional about that. However, it's very traditional that that's the penalty that's incurred. So you've had a huge reduction in what you thought was a $100,000 portfolio, and it is a $100,000 portfolio.
Yes, it was. For the client I'm thinking of, that's exactly what happened. A major mortgage company told them to do it, and they did it because they were so afraid of being homeless with their 4 kids.
Right, and that's the sad part, is to not have the home that your children are used to. But they also have to think about how are they going to plan for the retirement future. And not only did they get a punch in the eye, shall we say, a black eye from this financial move today, seeing $100,000 go down to 60, but they've also greatly reduced their chances of having retirement success, because the money in that qualified retirement plan is tax deferred. They don't pay any money on taxes till they pull it out.
So this family was in their 40s when this happened, because it was a joint situation.
Right.
And their tax penalty, not even counting the 10% portion of early withdrawal, but I do remember they came back to me and told me that they ended up owing the IRS $63,000.
Unbelievable.
And this actually happened because I've been a mortgage modification specialist since 2008. And I actually encountered this family in 2010. I heard from them actually last year, 2015. And they're still unable to pay that $63,000 back to the IRS because each year they're not paying that in full. There's additional penalties and interest from the IRS.
Right.
So that's why I really want people to know, if they do have retirement assets and they are in foreclosure or another very severe situation, what is it that would be a more intelligent way to access those monies? What would you recommend as a good alternative? Borrowing from it, perhaps?
Great leading question there. I love it. Yes, absolutely. It was a great handoff to me, and I appreciate that you mentioned it. Loans are available only on 401k plans. So if the person has assets at their employer, even if they only started working with the employer recently and it's a small portfolio, but they have an IRA account somewhere else, they can roll the IRA assets into their 401k account at their employer, and you're allowed to take 50% of 50%. The assets within your 401k plan up to $50,000. So you can't take more than $50,000, and you can pay it back $1,000 a month, probably over 5 years, and it'll be paid back. The best thing about taking a loan from your own 401k is the interest rates nowadays are usually between 4.5% to 5%. Wow. Very reasonable because it's your own money.
That's a benefit, right?
There's a unique characteristic in that interest rate. You're not losing it all, but it is interesting because you pay the interest with after-tax money, and then our partner, Uncle Sam, gets to tax us again when we pull that money out of the qualified plan. However, even with that, what I call double taxation penalty for when you're paying interest in your own 401k, it's still a great advantage to have that money to pay for this situation. Of course, you want to make sure that you've corrected your financial situation that created this whole problem before you take out the loan. Because heaven forbid you wind up not being able to pay back the loan, they consider it a clear withdrawal from your 401k, and you're stuck with that 10% penalty and taxes applied to your tax bracket.
So there is an alternative, though, instead of this clear-out liquidation to begin with.
Yes, absolutely.
Please tell me, what is the difference between a 401k and a Roth IRA in this type of a hardship money access situation?
Well, a Roth IRA, instead of a 401k, a traditional 401k, or a traditional IRA, is unique because the money going into it is all post-tax. You did not get that wonderful tax deduction when it went in. But the reward for that is if you keep your Roth IRA for more than 5 years and you're over 59 and a half, you get to take the money out tax-free down the road. So it's a very nice program, specifically well-suited for people that are younger and have lots of years for that money to compound. You get a great reward for that. But I'm wondering, are you asking that some of your clients might be looking at their Roth IRAs and saying, I want to take money out of the Roth
Yes,
in order
that's
to pay?
exactly what I've heard from people.
Okay.
They're looking on how to resolve their foreclosure issue. Let's say, for example, it's a smaller outstanding balance. I actually got a call this morning from a prospective client. They're only $26,000 in arrears, but that's it. They haven't paid their mortgage since January. Right now, we're in June.
Right.
So, but it's not the end of the month yet. So as you know, the mortgage month goes till the end. So even if your payment's due June 1st, you actually have a 30-day grace period, or 29 days, depending on the month. So right now, they're still classified as 5 months in arrears.
Okay.
They currently owe $26,000. However, they're self-employed, and they have a Roth IRA. So they were asking me, do I know if the best thing is for them to take the money out of their Roth IRA to catch up on the arrears of $26,000? What would say you?
Well, you know, what they could do, since they're self-employed and they create their own tax return, have a 1099 perhaps, what they could do is they could actually create a one-person 401k. It's a 401k plan for self-employed businesses.
So wait, they could take that Roth IRA and create it as 401k with that same money?
Yes. It would be called a Roth 401k.
That's a great answer.
Exactly.
How long does that take to roll into that? Is that a rollover? Is that the proper term?
It's considered a rollover.
Okay.
You probably do it as a direct rollover, which is what I usually recommend. And the money's in the account. It takes probably about 3 or 4 weeks to facilitate this.
Well, 3 or 4 weeks is still better. And do they still have the same access of 50% to that money?
50%
as
of
a
it
loan.
out. Exactly.
So that's the right way for a self-employed individual to access their money if it's currently a Roth and they still need someplace to get emergency funds from.
Truthfully, yes. Normally when I'm talking with somebody, I actually ask them more questions to see if there's any chance that there's other ways they can get access to money. Sometimes people are embarrassed to do it, but they have loving family members that are more than willing to help them out because unique situations happen in life. So I ask them the tough questions. Have you asked your parents for help? Have you asked a brother for help? And when they say, I've gone all these routes and nothing more is available, then we open the can to see what methods can be utilized to safely pull money out of a qualified retirement plan and be able to put it back in, not hurting their retirement future.
It's a great way to know, and thank you very much in helping my viewers better access their retirement savings to help them in emergencies that are happening right now. Thank you, Brian.
Thank you, Vivian.